Welcome to another in our series of talks on managed futures, macros, all kinds of things dealing with hedge funds. As usual, my name is Ken Millay, your facilitator. I'd like to turn things over to Meg Bodie, the president and founder of Talking Hedge Events. Meg, it's all yours.
Great. Hello, Ken, and thank you so much. And hello, everyone who's tuning in. We can see the room is filling up. We get to watch and see how many people are coming in. So thank you, everyone. We had huge registrations over the last 2 weeks. We know this is a really popular topic today. This is the fifth and final in our series that is replacing our trip to Toronto. As everybody knows, we're very sorry we couldn't get there, and we're very hopeful. We're so glad the border's open now and hopeful to get there next summer. Anyway, I want to get right into it. We have a lot to talk about. A fantastic, really exceptional group of managers in a discussion led by a manager of managers. Everybody knows Efficient Capital, and I want to thank Efficient for coming to us with this idea and helping us identify some great people for the panel. I'd also like to mention, before I thank the rest of our sponsors, I want to mention that all of the viewpoints, insights, and opinions that are expressed here today are those of the speakers and not necessarily the firms for which they work. So please bear that in mind. A little disclaimer there for you. So again, big thanks to Efficient Capital, to Alphadence, a new sponsor for us. Delighted to have Igor with us today. To Crable Capital, a longtime supporter of Talking Hedge. To Unigestion, new today. Happy to see Jeremy and meet him for the first time. To Auspice Capital, Lixor, InfraHedge, Bodie Research, FAR Capital, Graham Capital, O'Brien Investment Group, and Strix Leviathan. Thank you all so much for your support this summer. We were able to really have some wonderful sessions. Also, just hats off to our association partners, AMA, CASA, and Kaya. Very appreciative of their partnerships. Now I'd like to turn things over to our panel. Chad, you want to come on? Jeremy, Igor, Grant, let's get you guys in the frame here. Good old Brady Bunch. Love it. Okay, I'm going to say goodbye. Chad Martinson, our moderator today from Efficient Capital, please take it over.
All right, fantastic. Thanks, Meg, and thank you so much for the opportunity to chair this panel. Hello, everyone. Welcome. My name is Chad Martinson, and I'm the co-CIO at Efficient Capital Management. Efficient has been an active allocator in the managed futures and macro space for more than 20 years. I began with the firm in 2002 and have served as a portfolio manager for our flagship fund since 2008. We have a long history. We specialize in building multi-manager CTA and macro solutions for institutional investors. We have a meaningful footprint in the space, and I currently allocate about $2.5 billion. It is my distinct honor, again, to be chairing this panel, and I'm really excited about our topic. The overarching theme of the conference has been mining new sources of alpha with alternative investment solutions. And our panel topic today is managed futures, macro, and beyond, taming risk in a rapidly changing environment. This theme, I think we'll all agree, is quite timely. We thought we would start out with a few survey questions to help shape our discussion. And Ken, if you can put those questions up for all of the attendees to see. And as we're kind of walking through, you can answer the questions, and we'll bring those up later to help, again, frame our discussion. So the four questions that we'd like you to ask answer: who are you? What do you think the next 5 years are going to be like? What's your outlook on inflation? And what do you see as the main risk for markets and your portfolio in the near future? So while you're filling that out, and before we introduce the panelists, I thought we'd give you a brief outline so you know where we're going. We're going to start looking at a brief overview of the history of managed futures in the macro space, how the strategies have evolved over time. Then we're going to have a discussion about what is shaping the current opportunity and how that may play out over the coming weeks and months. And finally, we'll have a discussion about market risk and how the current risks might impact your portfolio. Our panelists today are a great fit for this topic. They cover the full range of strategies that you might invest in if you were to access the managed futures and macro space. They represent three successful firms within the space. Jeremy Gatto is the Senior Vice President and Portfolio Manager for Cross Asset Solutions at Unigestion. Next, we have Grant Jafarian, Portfolio Manager with Crable Capital Management. And finally, Igor Jelinek, the CEO and CIO of Alphadence Capital. At this point, we'll turn it over to the panelists to get to know them a bit better. Jeremy, could you start and talk about yourself, your firm, and your role at Unigestion?
With pleasure. Thanks. So I'm Jeremy Gatto. It's a pleasure to be here. So thank you very much for the opportunity as well. I started my career basically as a commodities trader, and I joined Unigestion about 8 years ago now. And I sit as a discretionary portfolio manager for our multi-asset strategies. For those who don't know Unigestion, we're a 22 billion shop, boutique asset manager, I would say, with a global presence in private equity, multi-asset, liquid alternatives, and also equities. And I sit, as I mentioned before, in our multi-asset strategies, which is basically a mix of systematic and discretionary. And it's a pleasure to be talking to you guys today.
Perfect. Thanks, Jeremy. Grant.
Thanks for having me. It's a pleasure to be here. Well, I've been around the industry, the alternative investment industry, my whole career. I actually spent a decent amount of time at Efficient Capital as a colleague of Chad's before leaving to start a manager seeding firm that was ultimately absorbed by Crable Capital Management in 2014. At Crable, I'm a portfolio manager of, in particular, our advanced trend portfolio, though I'm involved in the research initiatives across all four of our products. We are a systematic quant manager. We tend to trade on a shorter term timescale. For instance, our soft closed flagship is about a 1 day average hold duration. So we trade quite frequently. But again, we have four products that span sort of various different attributes of really systematic investing in futures and FX. We run about 8 billion in assets in total, and that's who we are.
Perfect. Thanks, Grant, and thanks for joining us. Igor, would you introduce yourself?
Yeah, sure. First, thank you very much for having me. I'm Igor Jelinek. I'm the CIO of the London-based company. We are active in systematic macro, and I've been doing systematic macro for the last 18 years, i.e. since the time when it wasn't called systematic macro yet. So quite a lot of time. And before that, I was doing a little bit of trend following CTA and quite a lot of management in the emerging markets, mainly in Russia.
Perfect. Great. Well, thank you all for joining. We certainly appreciate your involvement with this panel. So we thought we would start out with a kind of a brief overview of the managed futures and macro space and a look at the history of managed futures and how the strategies evolved over time. But maybe first, just to put things in context, we're coming out of a period, or perhaps still in a period, where traditional investments, mainly equity investments, have enjoyed a stellar run. We joke around the office that the S&P 500 is the new risk-free asset. Unfortunately, we have had that joke going for the better part of the last decade. So Grant, how should investors be looking at performance in the space over the last 3 to 5 years relative to other investments and maybe the value that macro and managed futures bring to their portfolio?
Right. Okay. So we're starting off right away with some of the hard questions here. I mean, the reality here is there's no question, I think, our space, and I think for the purpose of this panel, we're thinking about it as sort of alpha-oriented alternative investments, theoretically utilized to hedge or diversify a classic portfolio. No question, in the context of beta doing so tremendously well, particularly on the equity side, to your point, yes, the relative performance has probably been maybe even dubbed lackluster. I think the reality is we're in a world now where creating genuine alpha, and at least from our perspective here at Crable, we think about that in terms of convexity or trading long volatility, right? If we think about classic beta being, in a sense, volatility compression and risk declining and quantitative easing sort of buoying the markets, the reality is if you're really going to add diversification, I think you have to think about it in a sort of long volatility or positive convex way. It gets more challenging in that environment, and it demands, frankly, deep investment across the whole span of what you do organizationally. Not just, of course, coming up with brilliant strategies, hopefully brilliant, but thinking about how you deploy them from an execution perspective. Risk management has to evolve along this spectrum as well, and of course, every element of how you run your business from an ESG perspective has to improve as well. And in the context of creating really a risk profile for investors that maintains that positive convexity, even when it's so tempting to shift away from it. It's my personal view that the opportunity is there and it will show up. But in a world where volatility spikes happen very, very quickly, and now the recoveries happen even more quickly, staying in a sense true to that strategic calling of adding diversification, I think is paramount and never has been more so. Because performance has been a little bit more difficult in that context.
Great. Thanks, Grant. Now, Grant comes from a pure kind of systematic technical trading, price-based strategy. Igor, your strategy looks at a little bit more. It kind of blends both macro and technical factors. How would you put your strategy in context of the last 3 to 5 years?
I would say that the first thing which is important is that we think about our strategy as macro quantified. So we try to think about the markets through the prism of some intuitively clear effects which can be modelable, which are tradable at the same time. Such effects are typically pretty slow to evolve because the economy is a very slow thing. And they very often manifest themselves in a cross-section of returns, not in outright market returns, which is why we are able to maintain a very large exposure to dollar neutral or otherwise neutral portfolios. And as a result of this, we maintain zero correlation to main asset classes and zero correlation to other alternative investments as well, including CTAs and macro, classic macro. And I fully agree with Grant. What he said is absolutely right, of course, about diversification. Of course, it's great to have had this 10-year-long run in equities, but who knows whether this run is going to continue the next 5 years. If it does, yes, great, but what if it doesn't?
Yeah, so Grant's looking at directional opportunities. You're looking at cross-sectional opportunities. Jeremy, what makes a discretionary approach different and diversifying to both of these strategies while still being diversifying to traditional assets?
I guess for us, the idea is we have, as I mentioned before, some systematic allocation as well, which kind of is the foundation or our long-term strategic allocation. And on the discretionary side, what we try and do is just basically take advantage of potential market dislocation that we might see. We take advantage as well of potential events, because that's the difference between, I guess, the systematic allocation and discretionary one. The systematic one will take away the sentiment aspect of things. As a discretionary trader, we are going to try and look, there's an election coming, what are the risks, what's priced in, how's the market position, and this will all come into your decision making, of course, you know. So as Grant mentioned before, what we try and seek as well in our various portfolios or funds is diversification. I think is key, to be honest, in today's world. Many will compare usual traditional strategy, I would say, which is 50% equity, 50% bond, and the expected returns of such strategies going forward in a changing world are probably going to be less going forward. So diversification, being able to take advantage of market dislocations, etc. This is where, as a discretionary trader, it makes sense effectively to look at these market segments.
Perfect. Ken, maybe you can put up the answers or the poll results. Let's go down to number 2. What do you think the next 5 years will be most similar to? It looks like we've got a split between the last 5 years and runaway inflation, interesting, and then something we've never seen before. And then many of you wish you knew. Don't we all wish we had that crystal ball that would tell us exactly what is coming? So maybe on the backdrop of what the investors are seeing, what do you see as the drivers of return for managed futures and macro? What are the themes currently, and what do you expect moving forward? Maybe we'll start with Jeremy.
Sure. So I guess the main theme over the last few years, as you mentioned, was clearly a huge amount of accommodation in the markets, and I think a lot of investors are used to this. What we've seen post-pandemic is even more easing, even more money being injected into the markets. So I think the next 5 years, I would agree with the survey, are probably going to look a bit different, because we are probably going to be faced with inflation, which is a topic I would say that many investors are not used to anymore. And we expect it to last. We'll go into the subject, I'm sure, a little bit more later in more details. So going forward, what you'll see post-pandemic is probably some dispersion between countries, between assets, because obviously some countries will be better vaccinated. You look at the developed world today as one example. Other countries are lagging on that front, so they'll be faced with potential issues going down the line. So I think you're going to see a lot more disparity between countries and asset classes, and this is what will drive return.
And Grant, maybe for you, the SocGen trend index is up 13% over the last 12 months. So there has been some opportunity. The SocGen trend indicator is up 24% over the last 12 months. What's driving returns currently, and what do you guys see as the opportunity moving forward?
Yeah, well, and one point of clarification, here at Crable, we do have a trend follower, which I think when we use the designation CTA, I think often people think, oh, that's trend following. We do have a trend follower. We broadly see ourselves as more of a diversified quantitative trader, but I think it's an excellent question. And in the context of the SocGen indices, we're really talking predominantly of trend following. And there, we've seen, for instance, the commodity sector just sort of charge up to the top of everybody's charts from a trend following perspective. Obviously, on the heels, most likely, of inflation, it's been very steady. We've seen, wow, crude oil go from negative prices last March to 65 plus recently. I mean, that's just extraordinary, and it hasn't obviously just been crude. And inflation theoretically means we might have to think about how we're handling interest rates from a global perspective. Certainly, a domestic one here in the U.S. That provides a lot of opportunity as well. But I think, people's view that we're going to see an environment that we've never seen before is absolutely right. I mean, think about the number of environments we just haven't seen before. 2017, let's think about it. We had 4 days in 2017 where the S&P had an open to close move of more than 1%. 4 times that happened, all of 2017. I might be slightly off, but I think that's the number. I mean, goodness, you fast forward a couple of years, and we had 10-minute periods of time repeating where the S&P was moving 1%, right? So you have 2017, then you have this year where every 2 standard deviation event that the S&P, for instance, has seen has been recovered in something like 2 or 3 days, which is an extraordinary pace. We've never seen that before. So it's absolutely imperative, regardless as to your approach, whether it's trend or otherwise, to recognize that there's no question we're going to see things we haven't seen before, and being able to sort of attack that comprehensively as an organization is key. But hey, inflation, if this continues, I think commodities speak to the fact that that's going to be pretty good for trend overall.
Great. Igor, Jeremy mentioned kind of the relative disparity among different geographic regions, be it because of vaccination or central bank policy diverging. Given your strategy that's looking at relative bets across geographies, how does that shape up for a quant macro strategy like yours moving forward?
Well, to begin with, right now we're seeing a very little dispersion of returns if you look across the countries. And it's probably close to its historical minima. We saw something like this in 2005 when people spoke about death of volatility. Very funny. Then 2017, there was a dead period in 2013, 14. So that's approximately same kind of level of dispersion, very, very low, extremely low. And of course, when something happens in the market, all of a sudden, and it usually happens all of a sudden, you have a very large dispersion. You can't prepare for it. There is no way. It happens overnight, more or less, like it happened last year, like it happened in 2007. Many people will probably remember August 2007 and all that happened afterwards. If we go back in history, then probably 96, 97 would be such years. And we remember the Asian crisis, then the Russian crisis, and the LTCM crisis as a result of this. So this low dispersion of returns between geographies, between equity markets and between the bond markets is not sustainable. It's not going to stay like that forever. If you look at the expected volatility of your cross-sectional portfolio today, it will be very low because there is no volatility in these cross-sectional returns, but it will return overnight. And I will probably join the group of people who said, I wish I knew when that night is going to happen. So we'd better stay prepared.
Perfect. Thanks, Igor. Maybe we can look at the next poll question. What's your outlook on inflation? All right, so it looks like there's a pretty even splits between the transitory argument, which would certainly be supported by central banks, and it has begun and will continue for a long time. Jeremy, what would you say about your view on inflation? Is it transitory or here to stay? Are we at some sort of inflection point?
I think for us, it's our view at least is that it's here to stay. I think more important, it's worth being a bit more specific. I think inflation surprise risk is actually more of a market driver than inflation itself. So this is where we really see the risk. It's for the market effectively surprise to the upside on this inflation front and over a longer term period. So this is where I think we probably differ from central banks, since clearly the market is very split, or the audience is very split as to where we sit. But we expect this to continue. We see it in our indicators. So we're seeing these inflation pressures across all components of our indicators. And on top of this, what I would add is we still expect the consumer effectively to add a further boost to all of this. So as the economy is reopening, we expect that consumer to go out there, continue spending. Wage growth should kick in as well at some point, and that will fuel inflation itself. So we expect it to last. And as you saw in commodities this year, we have big supply constraints as well, which are not helping. So for us, at least, it's here to stay for the time being.
Yeah, and maybe just to follow up on that, money supply at 20 trillion. Obviously, we've got plenty of money in the system. Wage growth is starting, but velocity of money, we haven't really seen that tick up much. Do we need that, or are things going to be different moving forward?
Is that a question for me? Sorry?
Yes. Yeah.
Sorry. Yeah, I mean, I think, to be honest, this one part of thing you just mentioned it. This money which has been in the system has been huge and unprecedented. And in addition, what you're seeing now is infrastructure projects kicking in as well. So that's all going to fuel further that demand for some of these commodities and should fuel prices further. So these inflationary pressures, wherever you look now, across all components are there. And given what we expect, at least in the near future, we should see these pressures build further.
So, Grant, a recent paper came out by Man Group and Duke's Cam Harvey that showed that cross-asset trend and commodity investing have done exceptionally well during historical inflationary periods. At the same time, US equities were negative. Do you think that's likely to be persistent if we were to enter into an inflationary period? And how will CTA and macro strategies capitalize on that opportunity?
Well, it's an opinion, right? So I prefer not to be held to it, but certainly history would suggest we do very, very well trend following in general. There are a couple of underpinnings that, aside from the strategy itself, let's talk about contextualizing the global economy in a sense and what that would mean. If we, for instance, had to combat inflation, if we were able to do it by increasing interest rates, that creates some questions, and it also creates a really a nice kicker for managed futures in general and trend in particular. The concern would be, well, what happens when interest rates go the opposite direction that they have over the last 40 years? Haven't trend followers made just an extraordinary amount of money since the mid 80s to today, basically riding this long interest rate future position with the carry embedded in it? The truth is, if the trend reversed and wouldn't reverse and you're fighting the carry now, holding a short interest rate futures position, if it took 40 years, it'd be, yes, that position itself would neutralize. But it's most likely that would occur much more swiftly than the 40 years it took to get to almost zero rates to begin with. So I think there's interest rate opportunity. Then, of course, the commodity sector, we know what that's probably going to look like. I think Jeremy made some phenomenal points, not just on the monetary side, but in terms of demand and supply and imbalances there. But finally, one thing to note is if we see an increase in interest rates, I think we all tend to forget, especially myself, I didn't really start in the industry until 2001. There was a period in the 80s where the fact that managed futures and trend was so cash efficient that you could sit on 90% of your cash just earning, almost double-digit interest rate returns because it's so cash efficient versus any other investment class in a sense that has to leverage, right? So you're paying that rate in managed futures, you're receiving it. If we really encounter a world like that, you're going to flip the value proposition of what you can find in these cash efficient investment strategies like trend following. We just haven't seen it in 20 plus years, even 30. So it all things suggest it would be very favorable.
And Igor, what is your take on in the potential for inflation and the opportunity, and have strategies, Grant alluded to the fact we're 40-year bull market in bonds, have strategies adapted such that it would be challenging if that were to change, and how have your strategies changed?
Oh, that's quite a few questions. Okay, let me try to take them one by one. About inflation, if I look at the picture today, what I'm seeing, and just look at the US for simplicity. And the picture is much more multifaceted than that. So we look at current account. We haven't seen this level of negative current account since 10 years ago. We look at cost of shipping. We haven't seen this cost of shipping for also about 10 years. We look at trade balance. We have never seen such a deficit of trade balance in the history of the United States. We're looking at the credit standard in the United States, and we have never seen it so easy. We take a look at the next year. In the next year, fiscal deficit in the United States, it varies between various estimates, but it's somewhere between $4 and $6 trillion. The whole hedge fund industry doesn't have that much money. Who is going to buy all that treasury? I know one buyer. And you probably guess who that buyer is, right? So we're going to have another increase in money supply. And I can't see how it's not going to translate into further inflation. We look at unemployment numbers in the US. They're quite normal. Unemployment in the US is 5.4%. That's the last print, July print. And it's half of what it had been a year ago. So by all measures of normal behavior of the Fed, they should have already started to tighten. But they don't, because they can't. Because if they do, then the dollar is going up, the trade deficit is going to deepen, and the problem for the US economy is only going to exacerbate. So is there going to be inflation? I just can't see any other possibility. I don't buy the transitory argument. I mean, the supply shock, yes, there is a supply shock. Of course, it's been a component of the current inflation prints, but it's far from being the main component. And all the others, all the macroeconomic components, are not going to disappear anytime soon, in my opinion. And the worst thing about it is not that inflation is going to happen or is going to be long. The worst thing is that the behavior of central banks is now very limited. They can't do much. If we remember about the interest rates in the US before the global financial crisis, I will remind you that the Fed fund rates was at 5%. And now it's somewhere between 0 and 0. So not too much leeway. And therefore, I would also agree with people who said that the next 5 years are not going to be anything we have seen before. So in such an environment, getting back to your last question about how would I change my strategy in such an environment, I just try to remember about two things which make up the whole portfolio management, in my opinion. The first thing is that you try to come up with as good return forecasts and, in general, distribution forecasts as you possibly can. And the second thing is that you think what will happen if you are wrong. So you regularize your own forecasts, and it's very easy to trade the markets of the past. It's a little bit more difficult with the real markets when you need to place trades in the market every day. So to me, it's a combination of building good return forecasts and building a robust model. And therefore, I try to use effects which are repeatable, which are going to manifest themselves in the market again and again and again, regardless of the environment. And as we said, we don't know what this environment is going to be. So the strategy should be adaptable. It should be universal. It should fit into any environment.
You know, one of the key things that investors fully recognize is that equity markets have been a primary driver of return, certainly over the last decade. The Shiller PE ratio, you know, depending on what time frame you're looking at, is in the 90th plus percentile of where it's been historically. In the 100th percentile, if you're looking since 2000, 96, 97th percentile since 1970 and 1950. Given where we are with equities on the backdrop of the potential for inflation, what does it mean for equity markets? They've struggled historically. Is there a reason during inflationary periods, is there a reason to believe that it might be different this time? And really, how should investors be positioning their portfolio given that reality? Maybe Jeremy, starting with you.
Sure. So, I mean, equities have had a phenomenal run, as you said, you know, and I think it's also due to the fact that there's a lack of alternative income. You know, as you said, you know, rates are pretty much down to the bottom, ample liquidity. Where do you put your money? And natural way to kind of get some kind of returns is obviously to have an equity allocation. So for us, at least, inflation, potentially it could be negative for equities. It just depends on how it overshoots or not. But more importantly is also to monitor growth. And for now, we have growth above potential. So that's a positive factor for equity markets overall. So they should continue to do well. But I think more importantly, once we start seeing inflation, what's going to make the difference is you're going to have effectively to be more selective as to where do you put your money within the equity market, equity segments. So some sectors will perform better than others, obviously. And this is where you can make a difference more into relative value play in order to generate alpha as opposed to just pure beta where you just go along the market.
Yeah, and Grant, maybe for you, You mentioned this earlier. Equity corrections have been very, very swift and short-lived. The COVID correction started on the 19th, ended on as the 19th of February, bottomed on March 23rd, and then recovered very swiftly. How has that impacted your models, if at all, and how do you position a portfolio to capture potential opportunity?
Yeah, well, it has to affect your models, not necessarily in changing your strategic objectives or your core philosophy, but as an example, the microstructure has evolved. It continues to improve in terms of the players and how good they are at accessing market liquidity. We're dealing with extremely advanced, extremely technologically capable, high frequency traders on the other side of almost every trade that any alternative investment pool does these days. And what they're very, very good at is making tight markets when volatility is low and quantitative easing is strong and so on. And then they get out of the way when volatility arrives, and they're there at the bottom to sort of buoy it and push it back up again, which is exactly what happened, last February, March, and it's certainly what happens in the little pockets this year. The way you handle it is, and Igor mentioned this, you have to be prepared for anything. From our point of view, that means, one, start with collecting the data. How are you transacting? How are you pushing the market around? What does it look like on a sort of microsecond level, and how can you get better at it? It doesn't necessarily mean the alpha of your inherent strategies, in our case, trading anywhere from minutes to months, is not there anymore. It does mean that we have to get better every moment and making sure essentially we're not taken advantage of by these incredibly good, systematic, high frequency traders on the other end of our trade. If we can continue to advance there, I think we're going to see that alpha shine through even in this environment. But again, you have to think about the micro level just as much as you think about the macro, for instance, the risk management side.
And, we talked about diversification and diversifying equity beta, diversifying from traditional assets. Where can investors go for diversification? We actually had a question come across addressing alternative markets. Is this necessary additive? What are the key considerations? So, and thank you for that question. Where can investors go for diversification? Where can you go for diversification in your particular strategy? Maybe starting with Igor?
Yeah, sure. So we try to stay as liquid as possible. And we are very skeptical about going emerging markets, any frontier markets, and so on, private equity, this kind of stuff. There has been quite a few academic papers which show that if you were able to mark those investments to market, then you would get basically equity returns, like public equity returns. And frontier markets, you just lose your liquidity. You get some of liquidity premium probably, but then when you need your money, everybody will rush into the same door, and it may be quite painful. So to me, it's a very big question about whether you want to start receiving this illiquidity premium at this point in time. In my view, well, at least what we do, we try to be try to take most of our risk in cross-sectional models. I would also appreciate that strategies like the one Grant trades on a completely different time scale. It's probably the complete opposite of what I do. We may hold our positions for a couple of years pretty easily, and for him it's one day. And this means that there is no event risk while they hold the positions. So it's a great source of diversification for sure.
And Grant, what's your view on alternative markets, more esoteric markets? I mean, we, in one of our panel preps, we talked about crypto and what the opportunity is there. What do you think the best way to get diversification from instruments is?
Yeah, I mean, we've always been very proactive in trying to trade markets that we feel are sufficiently liquid. For example, in our products, all four of them, we trade well over 200 futures instruments. Now, up until now, we've traded exchange traded futures and OTCFX exclusively. Well, we trade in our flagship a little bit on the cash equity side, but in terms of moving into, let's take for example the idea of OTC, other OTC instruments, maybe in the vein of sort of an AHL evolution. We've looked at that, we've considered that. Really, we've doubled down instead on our investment in things like execution proficiency and getting better at our core business, because really the hiring of a team sufficient to do that right. And we would want to do it right. If we're going to make a splurge into that area, we want to make sure, everything's sort of buttoned up. The cost benefit there relative to again, investing in our core business, we didn't really feel it was there. Now, when it comes to China, when it comes to crypto, very different value proposition there. We're very aggressively considering those areas. When it comes to crypto, obviously we have the futures contract available now, and it is sufficiently liquid. So in our fund vehicles, we do participate. We, of course, let our clients know and make sure that everyone's comfortable with that. And it'll progress down maybe some of the managed account clients that we run as well in time if they're interested. So we're very open to it. But again, for us, it's more of a question of sort of the liquidity available more than it is, how we feel about these alt assets in general.
And maybe, Jeremy,
Yeah.
is it a markets traded, or is it a strategy that gives you the diversification?
So for us, diversification can come in many ways. I just want to touch base basically just quickly to go back on the volatility question, because I think it was an important one. I think when you combine effectively illiquidity and leverage, this is when it can get dangerous. I think 2018 was a very, very good reminder of what can happen to volatility. You had many instruments which was designed in a low volatility environment, such as the inverted VIX, which blew up that day. So I think what this tells us is we are probably going to be in a world where you are going to see more volatility. And it's also can happen very quickly. So overnight, as Igor was mentioning, but it quickly reverses overnight as well sometimes. So I think what you have to be prepared in these kind of environments is not to be passive, but to actually be dynamic. And this is what we do. And this is one source of diversification for us. But more importantly, in terms of just staying into liquid instruments, FX is a very, very good way of diversifying a portfolio. So if you have some equity beta, for instance, being long the dollar versus currencies like the Aussie, the NOK, which are very, very sensitive to beta in general. This is one way of diversifying portfolios without necessarily having to look at cryptos and other alternative markets. So within our listed or liquid instruments, FX is a very, very good way of diversifying a portfolio, we think.
Perfect. We want to leave a few minutes at the end for questions, but before we get there, the question of the risks that investors face in their portfolios and how they should be thinking about the risk and positioning. And then in your portfolio, kind of what gives you pause, what keeps you up at night, and how are you shaping things to anticipate that and respond to it? I think that's something that the viewers would be interested in hearing from each of you. So maybe starting right where we left off with Jeremy.
Sure. So for us, I was saying like the main risk is clearly inflation first. So we kind of position accordingly. So we long effectively, cyclical assets or cyclical commodities, which would benefit from that inflationary environment. At some point duration, we'd expect rates to move higher in such an environment as well. So the underweight or short duration is probably going to make sense going forward as well. So for us, clearly inflation is the main risk and not necessarily COVID, which I think has been on many investors' mind lately. But for the time being, we're more concerned about inflation than we are by a fourth wave or fifth wave of COVID.
And Igor, what keeps you up at night? What do you think investors are most concerned about?
Well, I don't know what investors are most concerned about. I know what I'm most concerned about. And this is what I call an idiot risk. And we have already spoken about inflation. The most interesting thing is how the central banks are going to react to inflation, to spikes of inflation, to those macroeconomic shocks, which are inevitable. And I just want to tell you a story from the very remote past. It happened almost exactly by the day 23 years ago on the 17th of August, 98. I was then in Russia. I was trading Russian assets mainly, and we were betting against the ruble because just half a year before that, oil went down from $20 to below $10, and everything was very poor. So we expected the Central Bank of Russia to devalue at any point in time. And here we come to the office and we see the monitor and we see one message saying the central bank is not going to support the ruble any longer. Great, we expected that. Immediately after that, the Ministry of Finance of Russia has defaulted on the GKOs, i.e. on the Russian denominated debt. And you don't default on your national currency denominated debt, especially if you decided to devalue. Nobody expected this level of idiocy. It's absolutely unpredictable. And this may lead the market into any direction. You just don't know where it goes. This is why I said that the portfolio should at any time be prepared, and your strategy have to be at any time be prepared to such exogenous shocks.
And maybe wrapping up with Grant before we get to the questions, what are the risks as you see them?
Yeah, I'm two different answers. One, portfolio related. I can't disagree. I know it's fun to disagree, but obviously everything that's been mentioned, absolutely critical to be thinking about. From our point of view, one of the things we're continuing to aggressively invest in is thinking about risk management from a bottoms-up perspective. I think especially if you think about the GameStop era of markets finding a way to hit stops, when you have top-down VAR limits, stops, et cetera, inevitably the market finds a way to find those. So we're thinking very aggressively about sort of intraday, how can we get ahead of these risk models and really position our alpha more advantageously intraday to sort of steer away from these top-down limits. That's something that keeps us up at night. I don't know, but it's certainly something that we want to get better and better at as a firm. I'm going to take it a different direction. Something that Michael Pomada, our CEO, talks about a lot. We do internally. Our compliance officer, cybersecurity, big deal. I mean, it takes one little fish attempt to disrupt your firm, and thinking about making sure you're in off-site sort of cold recovery scenarios and all those things, just in case something goes wrong, and how quickly can you get back up in trading, and how do you get out of positions and make sure everything is as it ought to be. The amount of training we're doing for employees, preparation, making sure it never happens. That does keep us all up at night, and we take it very, very seriously as an organization. I know it doesn't necessarily particularly relate directly to the portfolio, but it's absolutely essential from our point of view, and we invest very heavily in protection in that regard.
Well, thank you, gentlemen. There are a couple of questions. I think they're good questions that maybe we can answer. How does the panel truly define long ball? What is long ball? Maybe Jeremy, Grant's nodding his head. If one of you want to take that.
Sure, I can start, and if Grant wants to jump in as well, of course, he's more than welcome. But for us, long volatility is quite simple. As if you're exposed to the market, effectively, you're long vol. We also actively, on the discretionary side as well, look at options protections. So we have a risk book, what we call a risk book, where we look for protection in various market segments. We also have a long-term Vigo position, which will look at long-term volatility and to capture these big moves or these big tail events. So this for us is what we mean by long volatility.
Yeah, it's such a good question. I think, Jeremy, I would certainly agree. The question also suggested long vega. I think that's right. Look, we don't trade options, but the idea here is we're using the term long volatility, and I apologize, I use it almost more of as a metaphor, because the basic premise here is, if you're going to buy a put, right, you're going to lose money if you do it in a standard vanilla way forever. I mean, the premium decay is going to eat you alive. But if you can buy a put right before something happens, well, you got something that's very viable with a huge positive skew. Of course, that is trader skill. That is alpha, being able to acquire that volatility right before something happens. We sort of think about that in principle here at Crable, where we're essentially saying, look, we have to, in a sense, create strategies that are opportunistically trading when things are about to diverge. So in that sense, we think about it as long volatility, very much in a Vega orientation. But in our case, we're not trading options. It's just directionally taking positions in an attempt to get ahead of these big dislocations that could occur.
And a question for Igor. If you hedge against all kinds of exogenous shocks, what returns are left to make?
Sorry, I'm not sure I understand the question.
I think they're asking if you're fully hedged.
No, you're never fully hedged. You're never fully hedged. Come on, you always have some risk in your portfolio. It's just that you should be able to control those risks. You should be able to know your short-term expected volatility, and you need to know your short-term expected tails, and you should be able to protect yourself against unpleasant scenarios where your positions are not necessarily right. And taking no risk in the market is not going to bring you anywhere. And picking up from the previous question about long volatility, well, any position which makes you money when volatility goes up is a long volatility position. And my favorite example here is an anti-carry position in currencies. You go long the yen, you go short the Kiwi dollar, and you're long volatility, most likely. And yes, you will be paying carry for holding this position, which will be similar to paying time decay if you hold an option position. But yes, this will be just another manifestation of long vol. And I can go on with examples of long vol positions for a long time. They bond. You don't need to necessarily hold an option.
Let's see, we do have some more questions trickling in. How much weight do you base on arbitrage, which should decrease the risk of market directionality? This is kind of a similar question I have on total assets. So, I mean, how much should you base on a cross-sectional versus a directional strategy?
If it's for me, then I would say it depends on how you build your strategy, how you allocate risk. We have a dedicated risk allocation process which looks after it. It's quantitative, of course, and in our case, on average, over time, we will probably allocate about 80% to cross-sectional models and about 20% to directional models. However, at different points in time, it may be different.
All right, and maybe a last question before, a penultimate question. There is an observation that over the last few months, CTAs have underperformed. Why is that? Grant, you want to hit that?
Well, sure. And by CTAs, I assume we're talking again about trend following. Why is trend following underperformed, essentially? And
underperformed what? Most likely,
sure. Equities, presumably. I mean, look, the reality is you look at the S&P, you look at U.S. equities, and you say, my gosh, could it be any simpler than that? But you look beyond the U.S. and you don't see quite the same picture. For instance, just take a look at Asian equities, and it hasn't quite been as linear. In fact, I would describe it as extremely choppy. Interest rates have reversed, a long duration trend and traded into an extremely low volatility tight window. Then we had some foreign exchange moves where the dollar looked to be depreciating pretty consistently, albeit with very low volatility, and that reversed extremely harshly. So, there certainly has been an equity trend, but even that, I mean, the reality is from a trend perspective, you say, look, do we want to trade the 30 biggest instruments or maybe even the 20 biggest instruments? And the reality is that has an inferior sharp over the last several decades to thinking very aggressively about spreading out and diversifying your risk, which takes a lot more work. It takes a lot more investment. You do that. Sometimes there are cycles where it would have been better just to trade the NASDAQ. And let me tell you, it would have been a lot better just to trade the NASDAQ. But things change in a hurry. We're looking back on a period of time where commodities up until 18 months ago, let's say, basically had negative returns annualized over the last 10 years preceding it. And here we are looking back at in some cases, 10, 20, 30% attributions in commodities over the last 18 months. So, it's important to think about the cyclical nature of diversification.
Great. Well, thank you, gentlemen. The last question, there's been a lot of agreement on the panel. Hopefully we can get some disagreement on this one. If you have four options a quant macro strategy or a discretionary strategy or a systematic directional strategy or a multi-manager approach? Which one would you choose? I'll go first. Multi-manager. Grant.
Gosh, we at Crable, we invest in our own products. I'm not going to say anything, but hey, we're trying to create a comprehensive solution across all our 4 products. I know the work we put into them. I'm sure that's true of all the panelists. I'm not saying otherwise, but when you put your heart and soul into what you're trying to do, it's hard to advocate other things because you just know what you're doing and the work is real. So I'm going to have to say systematic quant from a Crable perspective.
And we can guess what the other panelists would say. Well, thank you all for joining us. I think at this point, we'll turn it over to Meg to wrap us up.
Oh my God, where did the hour go? That was absolutely wonderful. We, for the audience, you don't know this, but we get to see that you're there, that you're in the room. So many familiar names. I mean, really like old home week in a way. Lovely to see so many people tune in this morning. I hope you enjoyed it. I hope for those of you who have been able to join us this summer for our 5-part series, we certainly hope you enjoyed the entire series. And thanks again for all the support from the industry. We love what we do at Talking Hedge. We will be back in the fall. We're going to we wish we were actually traveling to Santa Monica, but still not safe enough to do that. So we'll be back with another series of webinars. So stay tuned. They'll probably start late September, maybe early October. We'll keep our footprint. We'll have a Friday morning session, and roll those out, and everybody's on our list. So you'll see that. And then we just signed a contract to go to Austin in March. So that's our flagship conference. We are really hoping. We have not really announced that yet because I think Austin is in lockdown again. It's not looking good there. So to all our friends there, we hope that improves. And to everyone, stay healthy, safe, have a wonderful end to your summer. Dog days are here. It's really hot in New York, just sweltering. But enjoy your weekends. Thank you to this panel. Fabulous job, guys. Really good to see everybody. And have a wonderful weekend, everybody.